As a business owner, understanding your numbers is one of the most powerful tools you have for growth. In this episode, you'll learn how to use key financial metrics to make smarter decisions, improve cash flow, and align your business goals with long-term profitability.
Welcome to Biz Help for You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
My guest, John Scott, partner at Anders CPAs and Advisors, shares insights on the 4 most important financial metrics every entrepreneur should track to scale with confidence. So, John, welcome to the show.
Thank you, Candy. Thank you for having me.
I'm happy to have you here too. And of course, like I said, I'm in the financial industry. I help people with the bookkeeping and payroll, and I talk to them a lot about how important understanding your numbers really is. And I think a lot of times people just put that to the side thinking, well, I just need my stuff done for my taxes. And they don't always look at the numbers. I would love for you to explain from your perspective, like, why is it so critical for entrepreneurs really to understand their numbers, even if they think they don't have a financial background and are going to find it hard to really understand?
Well, you are so right in that many business owners don't value the finance function, the bookkeeping function, and they hire their neighbor's niece who does it on a part-time basis, and they get stuff that is historical in nature. It's not current. It's 3 months behind, and they can't make any business decisions based on that. So we utilize what's called profit-focused accounting, and we assist businesses to grow and scale their business by focusing on 4 metric areas. It's cash, production, financial, and pipeline. And the cash piece is, how much cash do you need to run your business versus what you have? And we help them set targets to get there, because you don't want to struggle next week because payroll's due and you have to put money back into the business. We want to get you to a position where you always have enough money to pay your bills and hit the next payroll. And we think that's probably 10 to 30% of expected revenue for the year, which equates to 2 to 6 months of operating expenses. On the production side, you have to understand what drives revenue. I mean, if you are a maid service business that works on short-term rentals, how many clients do you need to support the people that you have? And on the financial side, again, historical versus current good data makes a world of difference in making decisions. If you can make data-driven decisions based on great data, then you can grow and scale your business. And then lastly, the pipeline. Where does our work come from? And you have to understand that if I have capacity, which I know now because I have good data, how much work do I need to fill that capacity? Because I'm not going to win every opportunity that I have. I need to know what my close rate is. So if I have 20% capacity and a 50% close rate, I need 40% of opportunities.
Mm-hmm. And so people who are hearing this now probably are thinking, I just heard a lot of information and I'm still confused on all of the things. So I would love for you maybe to start again with those metrics, starting with the cash. And if someone is saying, well, I don't even know how much revenue I'm going to bring in. My business fluctuates all the time. And, we've got seasonal things. We might be lower in a certain, month of the year and higher in other months of the year versus someone who just has like subscriptions where it's kind of consistent. How do I even begin to figure out those numbers if I don't have a regular amount of revenue I can count on?
Well, I think if you do have good current financial data, even if your seasonality has ups and down trends in it and some unknowns, you can still create a dynamic forecast. And I want to differentiate between a dynamic forecast and a budget. A budget is, I'm going to grow 10% next year, top line revenue, and have no net impact on net income. A dynamic forecast looks at that seasonality, looks at your pipeline, looks at the capacity you have and says, okay, I can grow X percent. And here it's based on the data I have, the known historical data, and what I know I have in place. If I have widget making machines on the floor and I have 10 of them, I know what their capacity is. Now I need to know, what kind of sales. So I can forecast in that unsure environment. And then, of course, the cash position, without the current financial data, that cash position would keep me up at night, every night until I hit my target.
Mm-hmm. Well, I think having a couple months, at least lead time, like you're saying, looking at the cash flow to figure out when is money going to come in, where do the expenses fall? Like you had said, to cover payroll. I had a client once that came to me that needed help with all of this too. And I was able to help him figure out, well, if you accelerate your receipts by even just a couple of days, you're going to have the money you need for your payroll. Versus, oh my gosh, like this has to be done and you can't postpone payroll, right? You might be able to postpone paying a vendor or something like that too, but even just maybe extending a couple days a bill you pay, getting money in a little bit faster, that also helps with cash flow too, and really looking at those numbers. So do you have any tips maybe for someone who has never really monitored cash flow? They're not sure really how to even implement this. Any tips that you can help them get started on actually monitoring that?
Well, certainly set a target of how much cash you need, and that's going to be 2 to 6 months of cash flow. And then the next step is reconcile on a regular basis. You don't need to wait for bank statements to have a reconciled cash balance. You need to always be able to look into your accounting system and say, that's my cash balance, and that's what I know it's right. And then what you refer to as delaying payment or collecting sooner, we call pulling financial levers in each of those areas. And there are non-financial metrics that you can pull a lever on to increase your cash position. And I love your example of, hey, I pay every bill when I get it. Okay, let's pay it at 30 days or whatever the terms are for the vendor. And let's improve our billing hygiene so that we collect faster. That's how you increase your cash balance and cash position.
Mm-hmm. So is there anything else in terms of the 4 metrics that you had talked about? I obviously focus on cash because that's so important as well to people, but any other tips that you can offer regarding figuring out the capacity or, like you said, the pipeline? How do I determine, exactly what it's going to take me to bring in the number of clients, so I can figure out those numbers?
Well, the other thing that we've done is we have a proprietary profit-focused maturity model. Maturity model is not proprietary to us, but we've tailored it to small businesses to judge the finance function within a business. And it's a self-assessment. So people go through 5 areas. They rate themselves 1 through 5. We also go through it. We usually align with businesses, and most clients in the maturity model of the finance function are at about a 2, with Nirvana being a 5. And what we do with that information is then we identify gaps and weaknesses in their function, and we set goals that over the next year we're going to work on these things to move that 2 to a 3, the 3 to a 4. We're never going to get to a 5, but if we can get north of 4, guess what? We have a business that's generating more profit and cash flow. We have a business that's more saleable. I mean, every business that's started should be started with the mind of how am I going to exit this business? And if you have current, clean financial records and a great finance function, somebody's going to pay a premium for that over coming in and the books haven't been reconciled in 6 months.
Right.
And then on the forecasting side, I like to liken this to taking a trip. And when your grandfather piled everyone in the station wagon, he pulled out the 10-year-old Atlas and said, okay, I'm going from St. Louis to Florida, and here's my route. And he just reacted to the construction that occurred or some accident that was there. And today we have the Waze app or GPS that anticipate roadblocks and construction and, a car stalled on the right up here. And it gives you a workaround. That's what the dynamic forecast does is because you have good current data, you're saying, hey, we didn't have the sales this month that we thought we would. Why? What do we need to do different to get back on track to get to our destination in a timely manner?
Mm-hmm. Right. And do you recommend that someone has a specific software that they're using for that too. I mean, Excel can be great too, but is there like a tool that you recommend to help them? Because I think, again, a lot of people are probably feeling overwhelmed saying, I mean, just coming up with the information in the first place is a little bit difficult, but to have it, ever changing, I'm not sure how to manage that.
Well, that's what we do for clients. But I think the first tool that they have would be their accounting system, whether it's QuickBooks or some other industry specific software. Just be current. Don't get behind. Don't hire your neighbor's niece to do it on, after her day job. I mean, hire someone like you to get current information, because the 10-year-old atlas is what most accountants do for their clients. They give them historical information. They don't say, hey, currently here's your position, and oh, by the way, your goals are this, and here's how we're going to get there. That's proactivity that is in some parts of the accounting profession, but not in many.
Right. Well, I do also try to educate on profit and cash flow and the difference. And a lot of people don't understand. They'll say, like, well, how can I have profit if there's no cash in the bank? So I would love for you to even touch on the difference between cash flow and profit. Why does someone look profitable potentially when they don't have money in the bank?
Yeah. It could be capital investments. A lot of times it's debt, and folks really don't understand that. Debt can be a really powerful tool, right? If your cost of borrowing, if you can earn in excess of your cost of borrowing, then you should borrow, but you should borrow for the right reasons. You should never borrow to support the owner's lifestyle or cash flow needs. But if there's a capital investment you can make, that's a good use of your cash. Go to the bank, borrow at even today's high rates of 6 or 7%. If you can earn 12 to 20% on that money, you're in a better spot. But when you make those principal payments, that is a use of cash that doesn't necessarily match up with the depreciation on that capital investment you have. So those timing differences are what they fail to understand until they're a little more mature in the process of going through those debt cycles and repayments.
I had someone once come to me too and just say, well, my IRS bill is, $10,000. I don't have any money, and I don't understand why they are saying I owe them any money. And she didn't understand she was living off the profit, right? So yes, you've spent the money, but according to the IRS, you still are technically profitable too. So I think that's where a lot of people get confused too, is not thinking about if they're drawing money out of the business, whether it's distributions, right, to officers, or it is just a sole proprietor and they're, taking the money out to live. So I personally think that's where a lot of the confusion comes from too, is they don't realize that the money that they're drawing out is technically the profit.
Right. And they've already spent that. And they're like, wait a minute, there's still cash in the business. How can I pay my taxes? The other thing we do, especially in flow-throughs or Schedule C proprietors, is we not only set a cash target for operating cash, but we set a tax reserve account target too. So we're looking at profitability along the way, saying, okay, if your tax rate between Fed and state is 40%, every $100 that you make, we're going to put $40 into a high yield interest account, so that when the estimate or the balance due comes due, that money is already pushed to the side. And so they can still take distributions, but we're going to protect those tax dollars.
Yep. Yeah, that's another tool that I like to recommend too, is the same thing. I remember years ago, even before I read, and I read Profit First from Mike Michalowicz, of course, too. But before I even knew about that book or anything, I used to tell people the same thing. Like if they had, say, sales tax that they had to pay quarterly, every month or every week or however long you need to look at how much you've accrued, that needs to be moved over into another account, so you don't see it in the bank balance thinking you have cash, right? And so do you want to touch on that a little bit more too, about what type of accounts maybe should they be having? How do they determine how much? Again, you use the example of tax, but people a lot of times don't even know where they fall in the tax brackets as well. So do you want to touch on maybe those accounts and how to figure out how to allocate for that?
Well, I think you certainly should have an operating cash account, and that would have 10 to 30% of expected revenues in it. You would have a money market account that you would squirrel away money for a big purchase or something that you want to do, maybe the bonus pool at the end of the year for your staff. And then another high yield money market account that would hold those tax dollars. And again, you're looking at profit on a monthly or quarterly basis and putting those tax dollars to the side. You know, and this is a little bit off topic, but back to one of your previous questions. The sales guy who's selling you the equipment or the new heavy vehicle, the Yukon, is pushing, hey, this is open and available for accelerated depreciation. And that can be a powerful tool in the right situation. But there's the mismatch between the deduction when I'm compressing income and the payment of the note for that vehicle or equipment. And in reality, if I'm going to buy something every year, okay, I can manage my tax brackets, but I really need to think about, do I want to accelerate the depreciation or should I take it over the normal length of it? And really, I work with a lot of professional service firms, law firms. If I've got multiple partners, taking that accelerated depreciation is not necessarily fair to the younger partners or to the older partners because I'm compressing income. If I buy $500,000 worth of equipment, completely write it off, I've just lowered income by $500,000 and I don't have that the $500,000 to allocate to the partners, and I'm taking deductions away from future years. So you really need to plan and not just react to, oh my gosh, I have to lower my tax bill today. Taxes are high and they're probably going up in the future. Somehow we have to pay for all the spending we did. And so sometimes those benefits of the deduction are better later on as well.
So how does someone determine, that obviously having an appointment with their CPA is important too, but a lot of times CPAs don't have time to sit down multiple times a year, with their clients, depending on how many clients they have. So what do you recommend for them to even be able to figure out, how do I determine, should I be taking things now? Should I be depreciating over multiple years? What is the tip that maybe you have for them to help them, guide them in those decisions?
If your CPA or bookkeeper doesn't have the chance to sit down with you, at least on a quarterly basis, to go through those questions, then you've got the wrong provider. You have to have a relationship with your financial service provider that is collaborative so that you can manage your business and make those decisions and not just listen to the salesperson. That salesperson may be right, but it might not be to your advantage to take that accelerated depreciation. And a lot of times there's fault on both sides, right? The provider's not proactive in reaching out to the client. The client makes a decision and tells the provider next April, oh, by the way, we bought $500,000 of equipment and we're going to write it off. It's tough to do things historically, but again, if your data is current and accurate and we're collaborating on a regular cadence, we can make good decisions for your business.
Right. And that is one thing I tell, again, because we don't do the income tax, we do the bookkeeping and then the CPAs do it. But often someone will make a decision not having consulted with their CPA and said, oh, I just, I bought this or I did this. And then the CPA is like, oh, I wish you would have talked to me first so we could really look at the pros and cons and, what do you want to do too? And so I always recommend to clients too, at least a couple times a year, sit down with your CPA if they're only doing the income tax too, and have those tax planning meetings, but do you have some very specific times where you're like, this is really one of those times you really need to sit down with your CPA rather than just a general tax planning meeting?
Well, I think if you're going to make a major investment in anything, I'll give you a specific example that happened very early in my career. The gentleman, he ran a demolition business, and he was one of these, everything's great or the sky is falling. And he looked at his pipeline. He wasn't getting a lot of bids. He thought the next 6 to 9 months were going to be really horrible. So he went to his 401k and he drained it. He took out $250,000. We had no idea. I would have talked him off the ledge and said, okay, what do we need on a monthly basis? Let's take a series of withdrawals. Don't take the $250. He never spent the $250. We paid tax and penalty on the $250. But it just made him feel better. Had we talked about that, I would have said, okay, if you need 10 grand a month, let's take 10 grand this month instead of taking $150,000. So I think it's on both sides, but it's up to the CPA or a bookkeeper to reach out to the client and say, hey, let's talk. What's going on? What's keeping you up at night? How can we fix it? Let's brainstorm together.
Mm-hmm. Mm-hmm. So do you have some specific like key performance indicators that you recommend? Obviously, we're talking about looking at cash flow, looking at financial reports overall. But in terms of maybe some specific numbers that entrepreneurs should be looking at to make those business decisions, what do you recommend?
I would focus on gross profit first. Okay. Regardless of your business, if you're making and selling coffee, if you're a law firm billing by the hour, you can determine gross profit. And then I would compare myself to peers. And
Mm-hmm.
it can be difficult to find that information. But again, your CPA or your bookkeeper probably works with other similar type businesses and can tell you that, hey, your gross profit at the law firm is 55%. That's pretty good
Mm-hmm.
because we can predict those below the line expenses and come back to if my gross profit's 40% and it should be closer to 50 or 55, then I've got a problem above the line in my cost of production, and I've got to go figure out what that is and fix it. So gross profit is the first and foremost thing that I would look at in any business. And if it's a service business, I would look at utilization of my people and realization. So in other words, if my people are producing something and there's some waste in there, what can I do to decrease that waste and get them more fully utilized? And then of course I have to determine value when I set a price to the client. Am I
Mm-hmm.
writing that up or down? If it took $10,000 to produce something, but it's only worth 7 to the client, I've got a realization problem and I've got to figure something out.
Mm-hmm. Well, and conflicting interests in this whole thing too, just talked about like utilization and things like that too. So we have, staff that labor costs keep going up or they want to be able to make more because their cost of living keeps going up as well too. Yet, we want to make sure that we are profitable and having a decent bottom line so that we can, again, plan for the future and all of that too. So how do you coach someone or encourage them to figure out what is like fair compensation for employees that are going to keep them motivated and happy to be working with you, yet still keeping your metrics in balance?
Well, I think that is industry specific as well. So you have to have some knowledge of the industry. For instance, a lawyer, non-owner, there's a certain metric that what we pay them influences their rate per hour, right? So the higher the rate per hour indicates that I'm paying them a base salary of a larger amount than the brand new person. So I think if you look at any production, whether it's, again, retail sales of a product versus a service, you can
Mm-hmm.
back into what can I pay these people. But the overarching thing that I think owners need to learn is if I'm going to give my people more money and I don't raise revenue, raise prices, it's coming out of my pocket. And they don't want to raise prices, but prices are going up on everything. And you see too many businesses that only raise prices every other year or every third year. And then it's a shock because in order to stay where they need to be, it's a big increase. Whereas if they would just increase it a little bit each year to keep up, then I think that it would be more palatable to the public.
Right. I think the struggle with that though too is right now if people are also thinking, well, prices are going up everywhere and if I raise my prices, my customers, are going to be unhappy, they might leave. I don't want to lose them because I need the revenue. But yeah, even in my business, we had one vendor that just raised their prices 11%, and so that's a decent amount. It's not just the small little amount too. And if we try to pass that along too, a lot of times customers might be grumbling too. So it's hard to sometimes kind of weigh that, yes, we have to do this to be able to stay profitable too, yet keep the customers happy. So what do you say to someone who's in that midst of the struggle and they don't want to lose customers? They don't want customers to feel that they're taking advantage of them, but yet their costs are continuing to rise significantly in some areas.
Well, I want to draw the distinction because losing customers is not always a bad thing. If you look at your customer base and you grade them A through D, sometimes you want to get rid of the Ds. They're demoralizing to work with for your staff. So I consulted with a CPA firm here in St. Louis, and they were doing an astronomical amount of orphaned 1040s. And by that, I mean 1040s that weren't associated with the business. And I merely suggested to them that they significantly raise their prices on those orphans, on the 1040s that had no business associated with them. And they really didn't want to do that. They didn't want to lose Aunt Minnie's return that, you know, they were getting $300 for. And I said, well, look, if you raise that to $750 and you lose half of the Aunt Minnie's, you're going to more than replace the income. In fact, you're going to have more revenue and you're going to do less work. You're going to be less hard on your staff. You're going to be less hard on yourself, and you're going to make more money. And it took a year or two for them to grasp that, and they were worried, and it worked out exactly as I said. And now they're more aggressively culling their client base so that they're only working with A and B clients.
Yeah, I was just thinking, though, what I've heard a lot, and someone even on one of my podcasts once, I think, said this too, is, of course, the ones that are often your D clients that are the ones that are the hardest to deal with because they take so much of your resources are usually the ones that are paying the smallest amount anyway, right? So if you decide to raise the prices on them and they go away, then, like I said, in the long run, you're more positive than negative too. So, you know, I think a lot of times there's fear in like letting people go. But like I said, if you're really looking at the numbers and how much are you having to spend time, resources for that client versus what you're bringing in, and if they are actually gone, or if you raise the price and they stay, at least you're making more to cover what you're, you know, already investing.
Right. How much AI are you using in your business today?
Well, obviously in software, some of it's already built in, you know, like QuickBooks will say like they're going to do certain things, but at the same time, you have to look at it. Like I've been telling clients this before too, is you can trust that the data that is being posted or, you know, brought in and QuickBooks thinks it's assigning it correctly is accurate, because usually when we're looking at it, it's not, right? You know, and so you know, there are things that are already built in, but at the same time, make sure that you're really looking at it and not completely trusting it, because it needs some help, right? You know,
it does. I do think it'll get there. I mean, if you think about it, when I was very young in my career, we had VisiCalc and Lotus 1, 2, 3, and now we have Excel. But before all that, you know, we did amortization and depreciation schedules by hand, and you used pencil because you made mistakes and you had, you know, it just took a long time. And then all of a sudden we had PCs and Lotus that would automate these things. And it created a lot of efficiency. And I think AI will get there for the same things, and we'll just be able to do more with less time.
Yeah, it'll be interesting to see over time how things happen.
You're right, though. You cannot trust what comes out the first time, and you got to look at it and tailor it. And
exactly.
I think the one good thing is it will. I'm not a big fan of offshoring, but I think it will lessen the need for offshoring.
Yeah, it will be interesting. Like I said, it's only been really used a lot, you know, in the last couple of years and on different, you know, areas, you know, too. A lot of people are using it for content creation and things like that too. But it will be interesting to see how things continue to progress. And how that impacts all the numbers too, right? Like you said. But I know we are coming to the end of the time that we have together. So I wanted to ask, do you have an offer that you would like to extend to our listeners? And if people want more information from you, how can they contact you?
They can reach me on LinkedIn, John C. Scott CPA at Anders. And then also I've written a book called Judicial Dollars and Cents. It's co-authored. It focuses on law firms, but it talks about the profit-focused accounting method that we use. And it's co-authored with my partner, Jody Grundon, who wrote a book for digital ad agencies. But these principles apply to all businesses. And then the other thing is, on our website, we have the profit-focused maturity model, where folks can take a self-assessment of their finance function and then at least set the current state of where they are so they can identify their own gaps as to what they need to improve on. Because as I said before, when you start a business, you need an exit plan. And if that exit plan is to sell that business, you need something that the next person who comes in can really rely on those numbers and believe in it. They'll pay you a premium for that business.
Exactly. Well, thank you so much for being on my show, John, and having this conversation. I really appreciate it. Of course, it's one of the things that I love, numbers and finance and understanding all of the things. So I always enjoy these conversations, but I'm sure that the listener will have learned quite a bit of information from you that's super helpful for them too. So thank you.
Thank you, Candy.
And to the listener, if you enjoyed today's topic and you want to hear additional information, you can find access to exclusive content in the show notes. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, a link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.